Point. I'm your host, Niraj Shah, and the talking points today are the views of Ridham Desai. Needs no introduction, and it's always great to have him around a big event. We usually do that around Diwali and the budget, and this time is no different. Rhythm, great having you. Thanks so much for joining in. Hope all is safe.
Thank you, Niraj. Great to be back on BloombergQuint with our annual budget fest. So look forward to this session.
Annual budget fest, indeed. Rhythm, what did you make of the budget?
Yeah, so just bear with me, Niraj. I'm going to give you a slightly lengthy answer. So just be patient, and I'll request your listeners also to be patient. So, we have to step back a bit. There have been three refrains that people have had, both the market as well as, macro observers in India about the budget. One is that the government spreads are not productive. The second is that the fiscal deficit targets have lacked credibility and transparency. And the third is that budgets in the past, many of them, several of them, have lacked any strategy. So they just address the problem of the moment rather than having a long-term vision or some strategy in mind. I think I'm going to step back a bit because it's not about this one budget. I think you should look at how things have evolved in India over the past few years, particularly since this government assumed office in 2014. So in 2014, and I'm addressing the first part of it, which is productive spends, the total cash doleouts that the government was making was about 3% of GDP. So this was being done through subsidies, through rural employment guarantee schemes and various other things that the government did, which is doling out cash to poor people. There was another aspect of this dole-out, and in fact, if you add up these dole-outs going back 30 years, they add up to more than $500 billion US. So we've really given a lot of money away. Doesn't seem to have made much impact because India still has a lot of poor people. And the reason historically was that these schemes were ridden with leakages, middlemen, and therefore money never reached the intended beneficiary. Now, two things have changed. One is that this government has started compressing these cash payouts. And in fact, just pre-pandemic, we had reached a number of 1.5% of GDP, which is a multi-year low. It had halved in the preceding 4 years. And the other thing was that the cash rollouts were linked to Aadhaar. So I dare say the efficacy and the reach of this cash was far more efficient than it had been in the past. And in fact, I think the leakages have now probably dropped to negligible amounts. So the cash was reaching the right people, which meant that the government could actually reduce the headline cash that was being given out because the leakages were, probably 50% earlier, and now, even though the headline numbers suggest that they are down 50%, they weren't really down 50% in the hands of the beneficiary. So a lot of money saved for the country and for taxpayers. This number, of course, shot up in the pandemic and went all the way back to 4.5%, naturally, because the pandemic caused a lot of pain for poor people, and the government needed to respond. Now, starting with last year's budget and with this year's budget, this number is now sub 2%. And I think it will probably go back to 1.5% and even lower in the years ahead. This is a major shift. What has the government done with this money? It has basically transferred this to building productive assets. So everything that the government builds in infrastructure is running at record highs. And the spends cumulatively have increased quite a lot over the past few years, including this budget. Now, I know there is a bit of a debate whether there was actually a 25% increase in capital spending because the budgetary allocation for capital spending went up 25%, but then there were extra budgetary resources that were reduced, and maybe the total capex did not go up as much as the headline numbers suggest. But I think that is not really of concern to me. What I am focused on is this transfer of non-productive spend into productive spend as a trend, which has continued. This budget has re-emphasized that and has restated the government's intention to go back to be on this path of productive spend. So first point addressed. The second one is with respect to transparency and credibility. Now, obviously, the governments in the past have kind of massaged numbers in the budget to achieve a certain fiscal target. There has been this unmentioned pressure on India that credit rating agencies will take a higher fiscal deficit negatively, and therefore you need to pursue lower deficits year after year. And of course, government itself wanted to be on that path, and it's a good path to be on. It is clearly the path that India needs to be on. But it did take away flexibility of previous governments to expand the deficit in years when it was required to. For example, pandemic was one such occasion. But the more structural reason for the government to use the deficit as a tool is when private investments are down and the government needs to respond to low private sentiment to bolster the economy. And this government has not been hesitant to do that. And that is, I think, a welcome change. Hopefully, the fiscal deficit will not be persistent, and the finance minister keeps reminding us that she is on that glide path down. And if that is done, then I think this ability to use the fiscal deficit as a tool to revive the economy, I think, is a welcome shift in government thinking. Along with it, we have seen that the government has taken a lot of off-balance sheet items back on the budget. So one of the reasons why this year's deficit did not fall as much is because this trend has again continued. Last year, it was Food Corporation of India. This year, it was a lot of PSUs that spend on capital, which the government is now doing on its behalf. So there's a kind of cleanup of the balance sheet. So that takes care of the aspect of transparency and credibility. And again, on the point of credibility, my observation, as well as a lot of people, think that the revenues may be easily achievable. Again, you go back in the past and we have really struggled to justify revenue estimates of previous governments. That's not the case anymore. The good thing is that the divestment revenue also has been crashed in the sense that it responds to the fact that you never achieved your stated targets. So why run such high targets and create a problem on the fisc and credibility of the fisc? And the third point is strategy. So I have mentioned this in our Diwali conversation, and I think even the previous budget. I see the strategy very clear. The strategy is, and I'm borrowing from the finance minister's speech, is that private investments need to be crowded in. And the government will support that until we get private investments going. So there's one more year that the government is going to support. And hopefully in the next 12 months, we get a private investment cycle back. Now, the context here is, you circle back to 2003, corporate private investments were at about 4% of GDP. At the peak in 2010, they were at 17%, and they went all the way back down over the previous decade to 5%. Excuse me. So we're sitting at pretty low levels of private investments to GDP. The government cannot do the heavy lifting of investing on behalf of the economy. It can only do it when there is a cycle which is depressed. And that is where we are right now. So the government is stepping in and trying to crowd in private investment. It has done various things to do that. We will not go into those details. We consume too much time. But that's the strategy. Now, where does this thing take us? So hopefully in the next 12 to 18 months, we get a pretty reasonable, visible capex cycle in the private sector. The government can then cut back on its capital spends. What that does is it allows the fiscal deficit to fall. In fact, I think because the growth cycle improves as a consequence of higher private investments, tax revenues go up, and come next budget, and for sure, I think the budget after that, which is Feb 24, just ahead of the election year, the elections, there's going to be scope in that 1 year between 23 and 24. And this may not necessarily be a budget event because GST rates are no longer in the budget. They're outside the budget. There may be a recalibration of GST rates. Now, what that will do is basically give a fillip to consumption because it puts money back into the hands of households, and households will be able to consume more, which is the virtuous cycle you start by crowding in private investments, then results in higher consumption and back into more investments. And I dare say the growth cycle gets extended from a normal, say, 2 or 3 year period to a 5 or 6 year period. So I see that strategy in place. What could upset this? Well, I think the most important thing is what happens globally. If the Fed falls far too behind the curve, then I think we may have a little bit of a problem. If there's a geopolitical event which causes oil to keep surging, then we have a problem. But otherwise, domestically, I think we are pretty much on this path of a new growth cycle where India's growth could go back above trend. Trend, I think, is almost a given in the next couple of years. The trend, I reckon, is between 6.5–7% real growth. And we could go above trend, which we have not seen since the middle of the first decade of this millennium. So I may have answered a few other questions that you were going to ask, but I took this opportunity to put the whole thing down. We got productive spending, we got credible fiscal deficit, and we got a strategy in place. And I think that's why the stock market is so happy with the budget. Of course, the stock market is happy anyway because earnings are coming back. The budget has not done much to upset it. Just one last point before I hand it back to you is that one nice thing about this budget is the continuing recognition of the importance of risk capital. So that was made last year, and again it was made this year. It was not just a statement that we love risk capital. The government is backing it up with subtle changes like what it did for long-term capital gains and the equalizing of surcharge. That whether the risk capital comes from the secondary market or the primary market, there is no point in differentiating between the two. Risk capital is risk capital, private or public. And I think that's a very strong signal. You add what the finance minister has said in various interviews over the last 12 or 18 months, it's a very strong signal to households who are currently upping their equity exposure. And my view is that this domestic bid on stocks is not going to go away in a hurry because the environment is very conducive for domestic investors to continue buying equities. So we'll see this bid, I think, persist for a fairly long time. We've been saying this now for 3 or 4 years. The seeds were sown when NPS and Provident Fund were allowed to invest in equities. It was like the 1980 401k moment in the US. And I think we're seeing continuing delivery of both policy as well as I would say words from the government supporting household action in favor of equities.
Yeah, and it was, of course, heartening to see in the press conference later that they adhered to the point, Ridham, that you made, that the divestment numbers had lost their credibility, and therefore it was important to bring that credibility back. Just 2 or 3 quick follow-ups on both the credibility question as well as the capex question. While it seemed optically 35%, a number of people pointed it out that against the headline capex growth of 35%, the actual number, as per the budget revised estimates for FY22, is nowhere close to 35, right? So is this the best that the government could have done, you reckon? And 2, could it have been worded better?
Sorry, what was 2?
Could it have been worded better? Because headline number is 35, but compared to the revised estimates, we all now know it's no longer 35% in the actual sense, right?
No, you're right. But one argument that I heard from somebody who was talking in support of the government, it was that it was a budget that was being presented and not the overall balance sheet of the country. But yeah, let us step back. Yeah, that could be an area where we could have seen, at least in the press conference, for example, there was probably less room in the budget speech to go into such granular details. But maybe in the press conference, there could have been some more debate and discussion around this. So there are many things that happen on capital spending. It's not a straightforward thing that the central government is the only agency that spends. There are the public sector companies, there are the states, there are other undertakings of the government, there are private or unlisted entities of the government. And when you aggregate all of that, actually we don't know what is the capex. We really don't know. See, what we are doing right now is based on what has been revealed to us. We're making an estimate and saying it's not 35, maybe it's 15, okay? But within that, I can cite so many things that are not known to us. For example, the finance minister said that this year we are going to have 25,000 kilometers of new highway contracts and a big boost on construction. So this is a doubling of the pace of highway construction from last year. Now, if you go into the budget document, the total spend on highways, budgetary support plus NHAI is flat year on year. So how is that possible? So in fact, the NHAI number is 0. And what I reckon is happening here is that NHAI still does not clearly know what number will be there, because there is a parallel activity going on monetization. So you're selling down assets. The budget, remember, is a financing document. Okay, so if you sell assets and use that money to create new assets, the net budget impact is zero. But from a economic perspective, from a macroeconomic perspective, I'm interested in the gross number, which is what is the new asset created. The sell down of asset is not a destruction of asset. It is just using equity. In fact, this is another thing where I think the bond market may have missed the plot, which is that there is a lot of equity using that the government is going to do over the next 4 or 5 years in lieu of borrowings that these public sector undertakings actually did to do their capex, whether it is in roads, railways, or in airports. There is a whole bunch of monetization that is happening, which is what? Which is equity being used to fund new asset creation rather than debt. So again, while we know that the government, central government's borrowing is 14.5 lakh crores plus, we actually don't know what is the gross public sector borrowing. For example, we don't know what the states are going to borrow, and we also don't know what the public sector undertakings are borrowing. So I think the truth is somewhere between 15 and 35. And I may as well say this, that nobody actually knows what the precise number is. This will only unfold in the next 3-4 months. I am not so fussed about this, Niraj.
Sure.
What I will refocus on the strategy. The strategy is to crowd in private investments with a robust dose of public capex.
Yeah.
So last year, it's happening this year. Now, whether the number is 15 or whether it is 25 will not make such a material difference so far as the government can execute. To me, the key risk is execution, not what the actual growth in capex is. And these capex growth numbers can always be revised through the year, because remember, they are heavily dependent on what government revenue collection is. And the government revenue collection includes divestment, it includes 5G auction, on top of taxes, on top of oil taxes. We don't know where oil prices are going. Will they have to again reduce oil taxes? So there are a few imponderables here. I'll focus on what the intent is, and then we'll see the execution as it happens through the year.
Yeah, and while some people say that it was a gamble, maybe it is the strategy worth doing, Ridham, because I think this is probably the way out. The heartening thing was there were no big dole-outs as so many people anticipated. Ahead of state elections, could there be dole-outs? And it was refreshing to see that that number was kept to a minimum.
Niraj, let me come on this, because it's a very important point to make. When the budget speech was over, the first thought that hit my mind is, oh my God, inflation. RBI will have to hike very quickly and fast. But then when you dig into the budget documents, it's actually not such an inflationary budget, because the headline expenditure growth is only 4.5%, which is sub-inflation, sub-normal GDP growth. So even when you're spending less than inflation, you're not going to generate inflation. It's the mix of spending which causes this reaction. If you strip out the capex, okay, the non-capex spending of the government is close to 0.9% year on year. This is a very, very important thing. And then if you strip out, say, interest and subsidy, the expenditure growth is 7%. So it is not a spendthrift budget.
Sure.
My reaction, instantaneous reaction without looking at the numbers, was pump priming. But it is not such a pump priming budget. It is pretty conscious of the fact that we are dealing with inflation risk. And it has not, I think, burdened the RBI with the heavy lifting, because there is no major headline growth in spending that we'll have to deal with.
Is there anyways a problem and a baggage of how the nature of the government expenditure is, Ridham? That is a worry per se? Because, simple question, as we spoke about before, are we headed into a bit of a debt trap because of the fixed, non-discretionary nature of the spend that India anyways has?
So, Niraj, this is a very important question, and it's good you asked this question, because the world is facing with the problem, not just India. Debt levels have shot through the roof during the pandemic, notably in China and the US. In fact, in the entire Western Hemisphere and in China. India has not been an exception, because governments have had to spend in order to offset the loss of output from the pandemic. Now, the only thing that goes in India's favor is demographics. all these countries that I mentioned, the Western Hemisphere and China, have got an aging population. So their growth is slowing down. Arguably, our growth is accelerating. So the government does have the hope that tax revenues will be materially higher than they are today in order to pay up for this debt that we have raised during the pandemic. The number that I focus on is primary deficit, which is over 3%. What is the primary deficit? It is the money that the government is borrowing to pay interest cost. Now, if a corporation did that, you would call that corporation bankrupt, right? If you are going to borrow money to pay interest, that means you are in a debt trap. For a government, that is not the case, because the government has a lot more levers than a corporate has to exit that. And my hope is that there will be greater room in the future as tax revenues stabilize. And the heartening thing is that tax revenues are doing very well. GST revenues as a percentage of GDP is now 60 basis points higher than what it was pre-pandemic. So all the skepticism about GST having failed, I think, should now be put aside. GST has been a very strong success in improving tax revenue collection, compliance, etc. Okay, and the chances are that this will go much higher because the economy is still not back to complete normalcy. So I think my view is we are not in a debt trap, but we have to be conscious of the primary deficit. And ideally, the primary deficit should be zero. So once you get to that position, then you are not borrowing any more to pay interest costs. You have walked out of a debt trap. India can do that. I'm not so sure about other countries because they will have to work a lot harder to do it.
Okay. We at BloombergQuint went into this budget with our tagline of "No Indian Left Behind." And one of the things that maybe a lot of people were watching for, we were certainly watching for, was whether there is some bit of how do I say, aid given to the marginalized, to the MSME, because they really presumably needed it. I mean, corporate after corporate in the listed space has come and told us that we've gained market share, but the others from whom we have gained the market share are in a tough spot right now. You think that was something that could have been done and was not?
No, Niraj, I don't think that should be done. So as a one-off during the pandemic, doing it was different because you had to prevent the tail risk of blowing up. I think the economic survey has very articulated this very well by using the word barbell. Okay, so instead of a waterfall strategy, this government has chosen a barbell strategy, which is a barbell means that you have equal bets. You're trying to protect the tail risk of blowing up, and at the same time, you are trying to revive growth. So I think during the pandemic, the effort was to prevent a blow up, because if firm after firm blew up, then it would put so much pressure on the banking system, you never walk out of it. Now, I don't think that type of support is required. Even so, the government has gone ahead and extended some of its ongoing support and even increased it. But the fact is that when the tide rises, all the boats will be lifted. So focus on lifting the tide, which is focus on lifting growth. When growth goes up, MSMEs will be back. The reason why we have had concentration is because growth has been low. When growth is low, large firms do very well. When growth is bad, everybody, in fact, I would say smaller firms will do a whole lot better than larger firms. This is not about GST. This is about growth. This is about the fact that growth has been subpar now, not for 1, 2, 3, but for almost 10 years.
Yeah.
Okay, so you cannot have subpar growth for 10 years and hope that smaller entities in the economy do well. So I think this will change in the next 3 or 4 years.
Inshallah. In which case, Ridham, last couple of questions. I know we've taken 20 minutes of your time already, but last 2 or 3 questions, if you will. One, you mentioned at the start of this interaction that you think that the bond markets may have missed a trick. The skeptic out there in the market suggests that maybe, just maybe, this elevated yields and maybe further tightening of the yields could happen. What's your view on how do the bond markets behave? Because I know you also keep a keen eye out on whether the MSCI bond inclusion happens and the impact that it has. And consequently, Ridham, what is the impact, therefore, on equities if indeed yields stay elevated?
So, Niraj, see, I think one of the disappointments of me from the budget was that the tax issue around the fully accessible route bonds, the FAR bonds, was not addressed. A couple of things need to be fixed over there: withholding tax as well as income tax return filing for global bond investors who are in no position to do that. if India wants that inclusion, then these things need to be addressed. I was actually quite confident that it will be done in this budget because all the signals were that from the government all the way to the RBI, everybody wants this to happen. Now, it has not happened. I don't know why. Maybe it's going to happen in the next 6 weeks. Maybe it's going to happen in the next 3 months. I hope it happens. It's going to take a lot of pressure from the bond market when it happens. It will take a lot of pressure from the banking system when it happens, because today banks are the primary funders of the deficit. And it will therefore fulfill the government's strategy of crowding in private investments, because it will release domestic capital for credit. Because foreign investors will do some of the heavy lifting on funding the deficit of the government. So I hope that happens. In part, no, if I came across as saying that the bond market may have reacted incorrectly, maybe that's not the right message that I want to give, because the fact is that the borrowing program of the government starts immediately. All the other upsides that may happen, which is that NHAI may monetize assets, or the states may run a lower deficit, or fully accessible rule bonds become a reality and bond inclusion happens, is something in the distant future, or in the 1 quarter, 2 quarters away. Right now, the government will start borrowing. So
Right.
the bid, the offer on the 10-year was probably justified. And since the market was surprised negatively by the headline deficit, maybe not so much on the gross borrowing of the system as a whole, the bond market reacted. Now, its impact on the equity market, I think, is not really that much, because the equity market only cares for growth. The yields matter when growth is not there. And if the numerator, which is your cash flows, are growing fast enough, you can easily tolerate a small shift in the cost of capital. This is not a dramatic shift. It's not like you've got a 100 basis point move or a 200 basis point move. So I don't think the equity impact is that much. In fact, if anything, the bond market is saying it looks like growth is coming back. I need to have yields higher. And if it is not disruptively done, which is that the RBI does not surprise us negatively or does not fall behind the curve, this is not necessarily negative for stocks. And this applies even to the Fed. The Fed is trying to manage the market debate on its exit, and you can see the volatility. So will we face volatility? Yes, we will. Will share prices still go up? Maybe they do. Will returns moderate year on year? I certainly think they are moderating. So we should not look at 2021 as any base case for 2022. But overall, is the bull market intact, and is it getting disrupted by slightly higher yields? I don't think so.
Okay, in which case, Ridham, my final question, and again, this is from an equity market watcher's perspective completely. What should be the strategy? Because if I look back at all the recent notes and your strategy notes that have come out, and I read some of them with very keen interest, the back of the truck and load financials, or your recent interaction wherein you talked about how some of the things which may not have performed thus far and have a case for performing fundamentally might actually see equity market support too. How do you see equities in the year 2022 before we wrap up?
Yeah, so I think, Niraj, financials seems to be the very obvious trade here. It is almost certain that the RBI exits this year. The debate is, how much interest rates go up by. We are a little higher than the consensus. So if we are right, then financials will do well, because financials actually need higher short-term yields to make money. Credit costs have certainly peaked. You can see that across the banks, and credit costs are tightly linked to profits. So if profits are rising with a lag, credit costs peak. Okay, so the reason why credit costs were elevated is because profits were falling, right? If you don't have profits, you can't service your loans. And credit growth also is a lagging variable of economic activity. So if economic activity, which in our view is picking up, credit growth will follow suit. So it will soon enter into double digits and maybe even climb to the mid-teen levels. So you add all this up, banks need higher interest margins and higher credit growth and lower credit costs to make money. So I think they will make lots of money in the next 2 years. So this is the period to be invested in banks. Large banks, I think, and even small banks will all do well. So if that's the single trade you want to put on the market, and that's the one, I think consumption will do well, because there is going to be a very good recovery in jobs and in wages, and as capex unfolds, even more jobs will be created. So discretionary consumption should do well. and industrials, because I think capex looks good, so industrials will do well. So those are the three sectors we like. And then if you have to be underweight stuff, then you want to be underweight the global, global sectors. So we are underweight energy, materials, and we continue to be underweight IT, which has been very painful. But I'm kind of getting stubborn now and maybe old. But as I said, IT is a good, solid, absolute story. My concern is whether it will be able to beat financials in 2022.
Well, Ridham Desai, always special talking to you. Thank you so much. Lovely having you, and have a great 2022.
Thank you, Niraj. Thank you for hosting me and for being so patient. And yes, wish you the same.
No, we love being patient with you, Ridham. So thank you so much. And viewers, thanks for tuning in.